Joining us right now is Bridgewater founder, co-chief investment officer, and co-chairman Ray Dalio, and we're thrilled to see you this morning. Despite the sun, there is a lot of hand-wringing going on here in Davos. You apparently were doing a little bit of hand-wringing about what may or may not happen in the years to come in your panel this morning. I just saw some of your comments, but I wanted to ask you, this guy, I think maybe you guys had a mind meld. Seth Klarman has a letter that's been going around Davos a little bit this morning, and it sounds a lot like you. He says, it can't be business as usual amid constant protests, riots, shutdowns, and escalating social tensions. You've talked a lot about social tensions, and he asks in the letter, social frictions remain a challenge for democracies around the world, and we wonder when investors might take more notice of this. Why do you think thus far investors seem to have tuned out all of this as noise?
Well, investors buy returns on stocks and so on, so it hasn't yet become a factor in terms of creating any disruption. There's a certain time horizon, maybe a few months, 9 months might be it. And so if you take corporate tax cuts, they make stocks worth more. Or if you have interest rates at such a low level that a return on investment of buying equities for those who own equities, I mean, the people who own their companies and they have buybacks, that supports stock prices. So the mechanics of that, even populism of the right, capitalism and making profits is what motivates the stock market. It's not what motivates the whole economy. So you have to realize that you're buying an income stream. And so it's those factors that are most.
So where are we in the income stream? And I should tell you, Scott Minard was sitting where you were in the last segment. He thinks a recession is coming in 2020.
So there's a significant risk of a recession. A recession, you know, is it -1? Right. Is it +1? Okay, so let's not get technical about that too much. There's a high likelihood of a significant slowing in 2020. And so now let's put that in perspective, right? We're in the later stages of the cycle. We have had certain things that mean there's a hump in growth, and then there's going to be globally a slow up. It's not just the United States, it's Europe, and it's China, and then and Japan. And we look at where we are in interest rates. So we are at almost zero. We have 300 basis points here. We have zero there. Those factors, together with the income gap and the populism, will lead to now the political election. We're going to start to enter the election season.
2020 already here, and this week some new candidates on the list. And
so with that, we're going to now have a question about the rethinking of how we're operating. That wealth gap has brought about populism, and with that, we're going to have the political conflict. The implications of the political conflict for markets are very profound, so we're going to start to talk about that. For example, is a 70% tax rate going to happen? Does that change how we will behave with capital gains? Does that have an effect? So these factors, the combination, I think, the three big factors are the combination of the wealth gap and the politics as we come to it, where we are in the later cycle, and the inability of central banks to ease as much. That's the cauldron that will define 2019 and 2020, in my opinion.
Go ahead. Go ahead. I was just going to say, where does the relationship between the U.S. and China fit into that matrix? Because I know that you've talked a lot about the sort of longer-term battle that might be emerging between these two countries.
Yes, I think that's another example of why this period is very similar to the late 1930s, right? So what are the factors? One of the factors is that we have a phenomenon in which there's a rising power challenging an existing power in different ways. There's a trade component of that. That isn't the most important component. I think the trade component can be dealt with well. There's a way of being component. China is from top down for its various reasons. It goes back to Confucius, it goes back to dynasties, and it is a way of operating. There's a bottom up. That issue has implications for supply chains. In other words, you have a range of possibilities. Nobody knows where that will end up. None of the leaders know the range of possibilities. If you take the worst case possibilities, which is, let's say, a conflict, then that leads itself to, am I self-sufficient? Are you self-sufficient? How are you going to deal with that? Those issues will be with us at the time. So what I'm saying is, if you take a period of time that's analogous of forces, these are the forces. The forces of the wealth gap. The top 0.1% of the population's net worth equal to the bottom 90%. You go back to the 1930s. If you take populism, as it has a political, you go back to the 1930s as that comparison. If you take where we are in terms of monetary policy, the ability to stimulate, because everybody's long. Everybody's long, everybody's leverage long, right? And you want to be leveraged long because everybody wants it to go up. That means central banks do things to make it, that provides credit. That's buying power. And you want to make it go up because everybody's leveraged long, and you're at a limit to that because you can't as easily lower the interest rate or you can't as easily print money and make it go up anymore. These are the inflection points. These are the issues of our time.
Right. If we're seeing some wage gains because of a tight labor market, and they are moving up more than they had been in the past, there's some anecdotal evidence that some of the people that were disenfranchised, still of working age, are coming back. There's some evidence that people have one job that they now feel confident to quit to move on to a different job where they have higher wages. Does that start to narrow the wealth gap in an organic way?
Not in a material way. I mean,
then how does a 70% tax rate?
I think we look too much at the average.
Okay, but can you assume that if there's a 70% tax rate, I can see how that holds back the wealth gap on the people accruing more? But can we assume that somehow it finds its way into the people on the lower end that need it, or it just initially it just goes to the government?
No, I think you're touching on the really important question. Is like there. Well, first of all, you have to deal with. There's so much that is not dealt with. How does it affect incentives? What is the money used for? How does it get redistributed?
Does it negatively affect the employment gains we just talked about that aren't that big, but at least they're happening?
But like education.
Okay.
Okay.
If you can assume
the terrible condition of education for the most part of the population. So what is the money used for? Or does it go to, does it go for universal basic income and so on? Then the question is the mechanics of it. If you have a 70% tax rate, if you look at it, the mechanics.
Well, I know it'd have to be on well below 10 million.
But then there's the question of the arbitrage. Does that become? Do I become a company? And now I have a corporate tax rate, and now I avoid the 70% because I'm a corporation. That affects the arbitrage between corporate behavior and individual behavior. Does that affect how the tax rates are changed? Will that affect corporate tax rates? Right. If it affects corporate tax rates, then it's going to have a knock-on effect.
I don't have a high degree of confidence that the federal government is an effective Robin Hood, right?
There are no specifics. You have no specifics as to what will the money go for, what will the other tax range, what will the arbitrages be. All I'm saying, I'm not commenting on it. I'm saying but it is reflective of the issue of our time.
Yes.
Right? And that issue of our time has got to be dealt with. Like if I was the president of the United States, I would have a commission and so on and deal with this in a manner that is thoughtful and worked out, because what we have is one side in a battle against the other side, and it's probably going to produce messy things that can affect the markets, but even more importantly than the markets, it affects our whole society.
Saying? You see my point, though. If it's not going, if the 70% that you're collecting, it doesn't effectively make it to where you're trying to help. There's no reason to meet at the bottom. It's a good thing when millionaires are created. We don't want to create an egalitarian society where everyone is poor.
That's why what we're saying here is that we have to re-engineer capitalism in a way that produces productivity, and there are ways of doing this. There are things like microfinance, or there's paying education. In other words, I think you have to do an all-in accounting of the costs. Like if you educate somebody, if you can't educate people well and you balance a budget, you're not dealing with the total cost.
I don't have a huge amount of faith that our shutdown government right now is going to do what you're saying.
Okay, well, neither do I, but I'm saying that issue. So let's now step back and be practical, okay, and say what is most likely. What is most likely is that as we're moving forward in the markets and the economy, we'll deal with monetary policy. We should touch on that and other things. But that will move over. We're going to have a slowing of the economy, not just in the U.S., but in Europe. And you're going to have a slower economy in other places. And that's going to have an effect. That'll bring growth down to a certain level. In that notion of how monetary policy will be part of that. And at that same time, politics and this disparity issue are going to merge. In other words, it will be the issue of politics. And with that, we're going to have glimpses of policy moves. And always those glimpses of policy moves and polls start to change, it'll start to cause investors to calculate, what does that mean for my return on the investment of the thing that I'm holding? And that is what the future looks like, I think.
Ray, can I ask you about what you said here last year? I think last year at this time you said that we were in a Goldilocks period and anybody who was positioned in cash was going to feel pretty stupid about it. I don't mean to give you grief because that's what we heard from a lot of people last year, and obviously you pivoted faster than anybody else because one of your funds was up 14.6%.
Yeah, I don't mean.
But
I said.
When?
I think if you take what I said was in the first half of the year, you're going to get that stimulation. And then you're going to have the Federal Reserve respond to that stimulation. Okay. And you're going to probably make it too tight. And if the interest rates rise faster than discounted, that tightness, I don't believe they could tighten at the rate that they said they would tighten, and including the balance sheet, without having a negative effect. And then in the second half of the year, I figured that was going to happen anyway. Look, last year I happened to be right. I could be wrong plenty. No, but in terms of that arc, and I think the Federal Reserve did make a mistake. They recognized things differently in terms of affecting the market and monetary policy. So you saw interest rates decline by 70 basis points, the bond yield, and so that represents the term structure of interest rates. If you take 70 basis points times the duration of the stocks, you have that lift and you have that reaction. So now we've changed. So I think we're now in a situation in which now you take the term structure of rates, which is basically that rates will not rise. That's what's built into the curve. If it rises faster than that, I think we're going to have another problem. And then, so it shouldn't rise. And then I think as we're going forward, when we take a look at how much will the economy slow, and also how much will some of the lending that supported the stock buybacks and supported the the big growth was corporate lending, which was financed because the cost of funds was cheap in relationship to the return on equity. And then we'll see how that passes through. So we're in that phase. Anyway, I'm answering.
Ray, we got to run, but I just have one very, very quick question, which is you have sorts of an inevitability to this recession. I know you talk about the economic machine. Is there any way that actually things turn up in a surprise to even you?
Well, yeah, I'm used to being surprised. So. I think there is the possibility that you extend equilibrium in a certain way where you have an easier monetary policy, because we have 300 basis points, and that you grow in a fairly slower way, and that you don't have a classic recession for a while. That exists as a possibility. And I think that's our best chance. But we're still going to have to deal with these other issues that we're talking about.
Long term. Ray Dalio, thank you so very much this morning.